Well, this is a very special interaction we are having on ET now. This is not about day-to-day markets, but this is more about how you should be approaching investing, especially in turbulent times. The theme of this interaction is making of a value investor. That's correct. This is the book I'm talking about, and it is by my dear friend Gautam Baid, practitioner of investing and internationally acclaimed author as well, and of course friend of the new investor here in India. Gautam, thank you very much for joining us, and congratulations on your second book as well. So before I go into the details of the book, talk to us about why do you advocate this practice that people should be taking notes of why they are buying a stock, what went wrong, or even they made a loss, the entire hypothesis one should be taking note of. Why do you advocate that?
Well, Ajay, there are multiple benefits of maintaining an investment journal. Firstly, I use it to learn a lot about myself and to correct my biases. Maintaining a journal has helped me improve greatly, both as an individual and as an investor. I've also maintained a personal archive of the media commentary and subsequent investor behavior during various episodes of Market Panic since 2014. And I find it highly beneficial to refer to this information whenever the markets undergo their periodic severe corrections, because human nature in the markets has not really changed much in many centuries. So maintaining a journal helps you maintain your equanimity and calm during periods of market turbulence. And most importantly, it also helps you avoid hindsight bias, because many a times we confuse outcome with the process. Many a times we may be right for all the wrong reasons. Investment journal helps prevent this bias and helps you get honest feedback on the outcome of your investing decisions. This is how you keep getting better over time.
Well, that's correct. Even Buffett, one of the market gurus which you follow and who have actually made a note also in your earlier book, also is a big advocate of maintaining a journal. Okay, let's dive straight into the book then. The origin of this book is also when the market was really bad, right? In turbulent times, how does helping making notes and entries, especially in bad times, how you can learn from, is something with the genesis of this book. So on June 5th, I see an entry from you in this book about small caps. And there is so much being talked about small caps. Even right now, the small cap, mid cap is very frothy. And a lot of young generation of investors have actually forgotten how small cap, mid caps are treated in a bear market, because a decent bear market hasn't come for several years. Small reluctant corrections here and there. So the memory of a good bear market is very small. Talk to us about what are your learnings about how the rules of small caps should be, and which you have learned painstakingly in a bear market.
Well, Ajay, that's a very good question. And the number of demat accounts in India have actually tripled from 3.5 crores to more than 10.5 crores since April 2020, when the last bear market actually ended. And very few people actually know what a true bear market actually looks and feels like. And a real bear market will actually will gradually wear you out mentally and emotionally. And it is only when the last bull surrenders and gives up that the bear market actually comes to an end. So, some of the biggest learnings actually always take place from a bear market, and those lessons bear fruit for an entire lifetime. And I've shared many of them in this book, and I will share a few of them with your audience today. Number one, if you want to make it big as an investor in the stock market, you need to be mentally and emotionally detached from stock price fluctuations, because during periods of severe market stress, it becomes extremely difficult to endure such sharp drawdowns. That's the first point. The second point is India will grow at a healthy rate. Nifty earnings will compound at low double digits. But at any point of time, there will be a few mid cap and small cap names which will grow their earnings per share at a rate of 25 to 30% over the next 3 to 5 years. And they are bound to create wealth in the longer run. You just need to have the confidence and the conviction to back them. In the long run, what ultimately counts is earnings, earnings, and earnings. Number 4, sanity will eventually prevail after every bear market, like it always does. So it is always the darkest before the dawn. You need to keep the faith that this too shall pass, and you need to just hang in there and not sell your high quality stocks in panic. you need to have extreme levels of patience. And the fourth and biggest learning, and this is very important, believe in India and the power of its entrepreneurs and business system. If you look at all the legendary investors of Dalal Street, all of them have got one common attribute. They all had a relentless belief in the power of this country and its long-term future. So these are some of the very big learnings, which will help you stay the course during difficult times.
Sure. The other very specific example I want to understand from you, Gautam, is about within small cap and mid caps, the investing world is always very excited about special situation investing, be it a buyout, be it some kind of merger, demerger, unlocking of value. This usually, is something which the retail HNI is very excited about. What are the things one should be very careful about as far as special situation investing is concerned? And you have made some entries in October around it. What are your learnings, and if you could share by examples?
Well, I've been practicing various forms of special situation investing over the last 15 years in the market. But in my view, the base rates of success are the highest in three specific categories. Number one, demerger of a micro cap or a small cap from a large cap parent has got residual institutional shareholding, because this often leads to forced selling in the small cap demerged stock after listing, after demerger, and that is when you get a deep value buying opportunity. So that's the first instance. The second one is that of merger arbitrage. So I'll give you a live example from the current market. So Ujjivan Financial is basically merging with Ujjivan Small Finance Bank, and for every one share of Ujjivan Financial, you will get 11.6 shares of Ujjivan Small Finance Bank. So if you just look at the merger ratio right now, there is more than a 15% merger arbitrage discount on the table. And we have a very high probability of this merger getting through and getting NCLT approval, because we had a similar reverse merger which recently concluded between Equitas Holding and Equitas Small Finance Bank. So you basically want to maximize your base rates of success by looking at similar situations which have taken place in the most recent past. It's not a stock recommendation, and we hold Ujjivan Financial in our PMS and in our India fund. The third category of special situation, which has got a very high success rate, which I've talked about in my book, is promoter or management change. And here, the really big money in promoter and management change situations takes place not when the business being sold was previously being run efficiently. The really big money is made when the previous management, which was running the business, either badly or far below potential. And this is so in investing, it's all about delta. That wherever you find the maximum scope of change on the positive side, that is where the really big money is made, because valuation re-rating is a key ingredient for multi-bagger stocks.
Very interesting. In fact, there's a saying on the street that you should always keep a stock on your radar where either the story is changing or the storyteller is changing, as far as special situations are concerned. Okay, let's move on and talk about another style of investing which investors do follow, and that is timing entry and exit in commodity stocks. You have made very good reference of investing in commodity stocks. What are the rules which apply there? Because a lot of times here in India, people watch data coming out of China and US and try to place their bets as far as commodity stocks are concerned. And a lot of time they turn out to be commodity traps. What is your learning out of that?
Well, commodity investing in general is very counterintuitive, because here, the lower the P multiple, the more expensive the stock is in reality, because the earnings per share, the denominator for these stocks, is the maximum at the peak of the commodity cycle. So here you ideally want to buy into such stocks when a couple of leading players in the industry are going bust, supply is coming out of the system, supply is reducing in the system, and you want to basically capitalize on the capital cycle theory here. So basically, capital cycle theory simply means that as the competitive intensity in an industry reduces, the return on capital of the remaining players in the industry starts to improve. They exercise better discipline, and during the upcycle, that is when you make the maximum amount of money. So you want to ideally enter into such commodity and deep cyclical plays when the industry is under severe stress. And again, you just need to check for two things primarily. Check the debt on the balance sheet to make sure that the company can survive another 1 or 2 years of an industry downturn, and check whether the company has got sufficient positive operating cash flow to service the debt. So once those elements are in place, and the industry supply situation is improving, that is when you enter, and that is how you get those big multi-bagger returns from commodity stocks.
Great chatting, Gautam. Like always, thank you so much for your time, and congratulations on the new book once again. Thank you very much.
Thank you so much, Ajay. This was a pleasure. Thank you.